4,280 construction companies in the United Kingdom declared insolvency last year. Not struggling, not restructuring. Gone. That is not a statistic about a sector in difficulty. That is the destruction of an industry that 6 million British families were depending on to build their future. To understand what that number means, stop thinking about companies and start thinking about homes. Every one of those builders had contracts, foundations half-poured, families who had exchanged, paid deposits, given notice on their rentals, told their children which bedroom would be theirs. Then one morning, a winding up notice appeared on company's house and the show was over. The home was never finished. In some cases, it was never started. And the family had nowhere to go. The last time British house building collapsed at this scale was 2008. Before that, you have to go back to the 1970s. This is not a wobble. This is not a correction. This is the systematic failure of an entire industry, and almost nobody in government is saying the word out loud. Let's talk about why. The government doesn't advertise what is happening to the British house building industry because, frankly, it looks catastrophic for a country that has been promising 300,000 new homes a year for the better part of a decade. But the insolvency service data, the company's house filings, the Construction Industry Training Board numbers, they tell the real story. In 2021, house building felt untouchable. Planning permissions were at a 10-year high. Persimmon posted profits of £966 million. Barratt was completing over 17,000 homes a year. Taylor Wimpey was handing out special dividends. If the share prices were climbing, the land banks were expanding, and every regional developer from Yorkshire to Cornwall was hiring. Then the walls started coming in. 2022. Material costs spiked to levels the industry had not seen in 40 years. Timber up 80% from pre-pandemic prices. Concrete up 35%. Steel up 50%. Energy costs to run construction sites doubled. The war in Ukraine was part of it. Supply chain fractures were part of it. But costs that go up in a crisis do not automatically come back down when the crisis ends. They stayed up. 2023. The Bank of England raised interest rates 14 consecutive times. The mortgage market seized. Buyers who had reserved new builds found they could no longer get the finance they had relied on when they signed the contract. The cancellation rates at the major house builders hit levels not seen since the financial crisis. Barratt's completions fell 30%. Persimmon's fell 33%. But those are the nationals. The regionals, the SME builders, the companies employing 40 people and building 200 homes a year. They had no balance sheet to absorb it. They just died. 4,280 construction insolvencies in a single year. Every quarter through 2023 broke the record set by the quarter before it. These are not abstract corporate events. These are companies with names on scaffolding boards across British towns. Buckingham Group, Street by Street Urban Renewal, Mid Group. Companies that had been building Britain for decades, gone in months. And the government's response? A housing minister who lasted 7 months, a planning reform white paper that was quietly shelved, and a housing target that was reclassified from mandatory to advisory. That's it. That's the plan. Let's start with the arithmetic, because nobody wants to talk about the arithmetic. A mid-size regional builder in 2019 was carrying a gross margin of roughly 20% on a standard 3-bedroom semi. They were buying land, paying subcontractors, sourcing materials, meeting building regulations, and selling the finished product with enough left over to stay alive and grow. That was the deal. It was tight, but it worked. Here is what happened to every single line of that equation between 2020 and 2024. Land. Land as a percentage of total build cost was already running at 25 to 30% in most of England. It did not fall during the crisis. Land values are sticky. Landowners do not drop their asking price because the builder is struggling. In many cases, strategic land promoters held firm precisely because they knew distressed builders would eventually have to pay up or lose the site to a competitor. Materials. The headline figures were brutal enough, but the hidden cost was volatility. A builder who priced a job in February 2022 and started in September 2022 was working off a cost plan that bore no relationship to what materials actually cost by the time they were ordered. Contingencies that would have covered normal fluctuation were wiped out inside a single quarter. Labour. A bricklayer day rate in 2019 was around £180 to £200. By 2023, it was £280 to £320 in most parts of England, higher in the southeast. This was not greed. This was a skilled labour shortage that the construction industry had been warned about for 20 years and never adequately addressed. The skills pipeline collapsed when apprenticeship numbers fell after the financial crisis and never recovered. There are 40,000 fewer construction workers in the UK today than in 2019. Add it up. A 3-bedroom house that cost a regional builder £220,000 to deliver in 2019 was costing them £310,000 to £330,000 by late 2023. The margin that kept the business alive had been completely consumed, and the price they could sell it for? Falling, because the buyers had disappeared. The cost squeeze alone would have been survivable if the demand had stayed. It didn't. In December 2021, the average 2-year fixed mortgage rate was 2.34%. By August 2023, it was 6.85%. That is not a rate rise. That is a different financial reality entirely. Let's make that concrete. A household earning £60,000 combined. They had been saving for years. In 2021, on a £280,000 new build, their monthly mortgage payment at 2.34% over 25 years was £1,230. At 6.85%, that same house, that same loan, cost them £1,950 a month. That is £720 more every single month. £8,640 more every year, after tax. They did not get a pay rise of £8,640. Nobody did. The purchase was no longer possible. First-time buyer numbers fell 23% between 2022 and 2023. New build reservations collapsed. Then Help to Buy ended in March 2023. This is important. Help to Buy had been propping up demand for new build homes specifically since 2013. It was not a general mortgage scheme. It was targeted support for new builds because new builds carry a premium. They cost more than equivalent second-hand homes in the same area, and without government equity support, many buyers simply would not pay that premium. The government knew Help to Buy was ending. They had announced it years in advance. What they did not put in place was anything to replace it. No new demand stimulus. No alternative first-time buyer scheme at scale. Just the end of the programme and a wave to the market. The new build premium, which had been papered over by the equity loan, was suddenly fully exposed. Buyers balked. Reservations dried up. Builders who had structured their entire land and development pipeline around Help to Buy buyers were left sitting on completed homes they could not sell. Here is what the government promised, and here is what it delivered. 300,000 homes a year. That was the target. It was the target under Theresa May, under Boris Johnson, under Rishi Sunak. It was announced and re-announced and committed to and pledged. The actual number of homes built in England in 2022 to 2023 was 234,400. The number in 2023 to 2024 fell further. The target was never met in a single year this century. In December 2022, the government quietly removed the mandatory status of local housing targets. Councils no longer had to meet a specific number. They had to demonstrate they had considered it. That single change, buried in a planning policy update with no press conference, no announcement, and no housing minister standing at a dispatch box explaining the consequences, released councils from the obligation to grant planning permission at scale. Applications that would have been approved were refused. Sites that would have been allocated were dropped, and the pipeline that builders depended on to stay solvent simply shrank. Then there is nutrient neutrality. This is the policy almost nobody has heard of that killed tens of thousands of homes in a single ruling. Following a 2022 Natural England Directive, planning authorities in 74 local authority areas were required to demonstrate that new developments would not increase nutrient pollution in protected water catchments. In practice, this meant thousands of planning permissions that had already been granted were suspended. Builders who had bought land, paid for surveys, designed schemes, applied for permissions and received them, found those permissions were effectively unimplementable. The homes could not be built. The investment was stranded. The government had helped build an industry on promises it was quietly dismantling. The builders didn't see it coming. Their land banks were premised on permissions that would never come. Their business plans were built on a demand subsidy that was being switched off. Their margins were already gone. And nobody in Whitehall used the word crisis until the insolvency numbers became impossible to ignore. Stop thinking about companies for a moment. Think about the buyers. In 2022 and 2023, thousands of people across Britain exchanged contracts on new build homes that were never completed. They paid reservation fees, or they paid exchange deposits, typically 10% of the purchase price. They gave notice on their rental properties because they had a completion date. And then the builder went into administration and the site stopped. The deposits were unsecured creditor claims against a company with no assets. Some people got a fraction back after months of legal process. Some got nothing. There is no compensation scheme. There is no protection in law that meaningfully covers an off-plan buyer when their builder collapses. It is just gone. Think about the workers. A site manager in his late 40s, 20 years in the industry, working for a regional builder in the East Midlands that had been trading since 1987. 2 weeks' notice. No redundancy because the company had no money left to pay it. The skills he spent 2 decades developing are not transferable to another industry in any obvious way. And the regional pipeline he would normally step sideways into has contracted so severely that there are fewer roles available within commuting distance than at any point in his career. Think about the family on the council waiting list. A development of 240 homes was planned for their town. 72 of those homes were designated affordable housing under a Section 106 agreement with the council. The developer went bust. The site is now in the hands of a receiver. The affordable units will not be built as planned. The family has been on the list for 4 years. They are still on the list. No home is coming. These are not edge cases. These are the direct human consequences of a structural collapse that the government is describing as a market cycle. When a regional house builder collapses, the site doesn't disappear. The land sits there, and somebody buys it. Institutional investors and private equity have been acquiring distressed development sites throughout the downturn at prices that reflect the collapse in the market. This is not illegal. This is not even unusual. This is how capital markets work. But the entity acquiring the land is not planning to build homes for people to own. It is planning to build homes for people to rent. Permanently. Build to rent has grown 26% year on year since 2021. That growth is not happening because Britons suddenly want to rent forever. It is happening because the conditions that killed the builders, high rates, high build costs, a frozen buyer demand, are the same conditions that make bulk institutional acquisition of rental stock extremely attractive to a pension fund with a 20-year horizon and no need for short-term margin. Here is the irony that nobody will say plainly. The financial crisis that destroyed the housebuilders who were trying to sell homes to British families created a buying opportunity for the institutional investors who want to rent those same homes to those same families indefinitely. The family that could not buy because their builder went bust may well end up renting from the fund that bought the site at a discount. They are paying for the same bricks. They just will never own them. This is not a cycle. A cycle corrects. What is happening in British house building is a structural loop with no automatic exit. Fewer builders means fewer homes built. Fewer homes built means supply falls further below demand. Supply falling below demand means prices stay elevated or rise. Prices staying elevated means affordability stays broken. Affordability staying broken means buyers stay frozen. Buyers staying frozen means builders cannot sell what they build. Builders who cannot sell go broke. Fewer builders start again. But there is a second loop inside the first one, and this one is more dangerous because it has winners. The collapse of the SME house builders has consolidated the market. Persimmon, Barratt, Taylor Wimpey, Bellway. The Nationals lost volume, but they survived. They had the balance sheets. They had the land banks. They could slow build and wait. And a slower build rate in a market with chronically insufficient supply means the price of the homes they do sell stays high. Persimmon's revenue per unit increased, even as its completion numbers fell. That is not a coincidence. That is the economics of an oligopoly operating in a supply-restricted market. The large nationals do not have a financial incentive to flood the market with supply. Their share prices are not rewarded for volume. They are rewarded for margin. Restricted supply means better margin. The death of their smaller competitors was, from a pure shareholder perspective, a convenient outcome. And the planning system, the land market, the skills shortage, and the financing environment all make it nearly impossible for new SME builders to emerge and compete. But this is what a broken market looks like when it has stabilised around its own dysfunction. What has happened to the British house building industry is not a recession. It is not bad luck. It is not the inevitable consequence of external shocks nobody could have foreseen. It is the result of a political economy that spent 30 years treating housing as an asset class rather than infrastructure. House prices that go up are good news for homeowners, and homeowners vote. Planning restrictions that constrain supply protect the value of existing homes. A government that allows house prices to rise indefinitely while promising to build more homes is running both sides of a contradiction, and at some point the contradiction resolves violently. On the government, it built an industry on subsidies it always intended to remove. It called it a housing policy, and is now calling the collapse a market correction. On the large builders, they watched their smaller competitors die, acquired their land at distressed prices, and are now building fewer homes at higher margins, and calling it prudent capital allocation. On the financial system, it turned a basic human necessity into the most important asset on a British family's balance sheet. And asset classes do not care whether people have somewhere to live. They care about yield. The builders who are going broke are not the villains of this story. They are the last actors in a system that was never designed to actually house people. They were just the ones closest to the ground when it gave way. Somewhere in Britain right now, there is a family who reserved a home 2 years ago. They paid the deposit. They handed in notice. They told their kids. And then the company folded and the site went quiet and nobody called them. They are still waiting. Not because there is a shortage of land, not because there is a shortage of people who need homes, but because every system built around British housing, the finance, the planning, the politics, the incentives, chose to make homes expensive rather than available. Britain doesn't have a housing crisis. It has a housing industry that stopped believing its job was to house people. The builders who still believe that are gone, and the ones who replaced them never did.